Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics. And look who it is, Mr. Dorides. Where you been, Cris?
Mark, I've been over in Italy visiting family,
Yeah.
so happy to be back, though. Missed
Yeah,
the podcast, missed all of you. So.
Yeah, we definitely missed you. We talked about crypto. Were you on the crypto podcast? Did you miss that
I
one?
was.
Oh, you were
I
on
made a
that
special effort to join that one.
Oh, that's right. Yeah, well, we were glad to have you. And we'll talk a little bit more about that later. But it's good to have you. And the sabbatical was good.
It was.
Yeah, that worked out. So how long were you? You were gone for like
3 weeks.
Oh, it felt like 3 years. Jeez.
Oh.
3 weeks. Okay. Yeah. Okay.
Yeah.
All right. Yeah, I know Ryan missed you. Yeah.
Very much.
You have someone that can't answer his statistical riddles. So, yeah, that's you.
Oh, did you keep up? Did you?
I thought I did pretty well, actually.
You did really well. You were on a hot
I
streak.
did. I was on a hot streak. You missed
Oh,
it.
wow.
You missed it,
Okay.
Cris. Yeah.
I just miss having someone back me up when going
Yeah.
back and forth about interest rates and housing starts.
That's true. That's true.
Well, we got a lot to talk about with the 10-year today. So
There is a lot to talk about. Well, you've heard Chris's voice. He's the deputy chief economist, and also just Ryan's voice, the director of real-time economics. And Ryan has received a order from our producer, Ben. Ben has told Ryan not to mute himself. I'm not going to go into the reasons why, but apparently that's a dangerous thing in your household, Ryan.
It's very dangerous because my children are going to come home from school any minute. It could get loud.
It could get. That's okay. I'm all for it. Yeah, I'm all for it. Yeah. I've had my problems with my dogs, and who knows. We also have our colleague Bernard Yaros. Bernard, good to have you back. You were on our podcast not too long ago. A couple months ago.
It was back in
maybe?
May. Back in May, so it's a couple months
Really?
ago.
That
wow.
long ago. Wow.
Yeah, time
I can't
flies.
even believe it. Yeah.
Yeah,
And Bernard is a Renaissance man. He's the guy who can speak, if you can recall, like 10 languages or something. One which is Arabic, right? He roamed around Yemen for a year or something.
Yeah.
I think I have that right?
Yes.
Yeah. And also I don't know if he still plays squash, but he's like legendary in the Philadelphia squash courts. Are you still like king of the squash courts here in Philly, or?
I have not. I retired my racket several years ago. Actually, when I started at Moody's, so a month when I started Moody's into like my job here at Moody's, I tore my Achilles, and for like the first
that's
year
right.
at the job, I was limping around with a boot and crutches and all that. And after that, I never wanted to play squash again. So.
At one point I was a pretty good squash player.
Yeah, no, we used to play at the same club, Berwyn, right?
Yeah, Berwyn. I love Berwyn.
Yeah, Berwyn. Yeah.
I got to go back. I haven't played in such a long time. I miss it. I really do.
Yeah,
it's a great
sport.
sport. Yeah, really great sport. And Bernard follows everything related to the federal government, and of course, that's kind of front and center here in the public discourse around the budget. Debt ceiling. We're going to talk about that. Bernard and I wrote a paper about that recently that's on Economic View, and government shutdowns and the reconciliation package, a lot going on there. So that's the big topic for today, really. Or I should say policy in general, right, Ryan? Because the Fed had a meeting this past week. We want to talk about that as well. So let's just say that the big topic today is policy, monetary and fiscal policy. So we'll get to all of that in just a few minutes. We had a marathon podcast last week on the global supply chains, and that lasted, I think, an hour and a half. So I think that's a little long. Don't you guys? I don't know. I got mixed reviews on that. So we'll try to keep this one a little shorter than an hour and a half. Although with Bernard on, who the hell knows? I mean, he goes on and on and on. But we'll try to rein him in. Okay. Let's talk about the statistics, and we play a bit of a game here. Ryan, Bernard, are you going to play this game with us?
Of course,
I think you did. Yeah, of course you are. Yeah, absolutely. Okay. And Ryan, as increasingly per tradition, he's going to lead the way, right? Because he's the king of these statistics. So, Ryan, what's your statistic of the week?
17. I don't want to give you the units because it will give it away, but 17 is the number.
17. And it's a statistic that came out, excuse me, this week.
It did.
17 days on market, or
Oh, Bernard, good job. In the
What?
existing,
Wow.
the number of days a existing home has been on the market before it sold in August was 17 days.
Bernard,
Anything-
Ryan gave that to you. He
No, I
fed
did
that
not.
to you.
nope.
What the heck's that all about? I mean, he said 17, and you just got like went right.
Because I
he's been
knew
boning
if
up.
he said
Impressive.
days, we'd all know immediately what
Right.
you
Oh,
know,
that's
what it
right.
is. So
And that's a statistic that generally would come from Cris, not from Ryan, because it's
Yeah,
housing.
I picked that one because I was like, let's ease Cris back into this. Here's something housing related.
Right.
He's a little rusty.
Yeah.
Makes a lot of sense. Makes a lot of sense. So,
But
what-
17 is also the debt, the size of debt of households. That's where my mind was headed.
17
That's
what?
a good one.
17 trillion. Yeah.
That is right. That's right. But that wouldn't have been fair for Ryan just to say 17 without the. Well, no, you're right. He said, I'm not going to tell you the units. So
Right. If I
yeah,
said
right.
trillion, you would have known that right away.
Okay. So what's the significance of the 17 days on market?
So even though the housing market appears to have cooled a little bit, demand remains very, very strong. It's more a supply side issue. Kind of like last week we talked about all the supply chain issues. Housing supply is very, very lean, particularly for the existing home market, and that's starting to cut into housing demand because affordability is dropping. But if you have it, if you own a house, you put it on the market, it's going to sell very, very quickly in this current environment.
Although I think it has cooled a bit, hasn't it? A little less quickly than towards the beginning of the year, right? Because it doesn't
Yeah.
feel as frenzied to me right now.
Yeah,
Right.
sales have cooled off, but I think
Yeah.
that's a reflection of lower affordability because house prices are rising quickly. But still, existing home sales are well above what we saw pre-pandemic.
Yeah, right. Cris, you concur with that diagnosis that Ryan just gave on the housing market?
I do, but I am concerned that things are slowing down.
On the demand side.
On the demand side as well. As prices continue to rise, those affordability issues come into play, and we see signs of buyer fatigue and people just giving up and saying, I'm going to sit this one out after having lost 10 bids, right? So I think there's I agree that supply is the larger factor, but demand is starting to weaken as well, is my read.
Did you notice that the share of sales that are going to first-time home buyers is now falling off pretty quickly? Did you catch that?
I did.
Yeah, from both the realtors' data and from, I believe, FHA, they report. This is on the loans that they insure. They can identify whether someone's owned the home within the past or has purchased a home within the past 3 years. If they haven't, they call them first-time home buyers. And the share of loans that are insuring that meet that qualification are declining. So it looks like first-time home buyers are really the biggest casualty of this surge in housing values and the decline in affordability.
Yeah, supply at the lower end of the market is especially tight.
Yeah.
So.
Right.
But
Right.
some cooling in the housing market is a good thing as long as it's orderly. I mean, the housing market over the last year was pretty unhealthy.
Well, here's my question. What happens when mortgage rate? I mean, all this has happened without any move in mortgage rates, right? Mortgage rates are still at record low, below 3% for a 30-year fixed rate loan. What happens when mortgage rates just move up a little bit and conflate with these higher house prices? I mean, I don't know. Makes me a little nervous about the market. The adjustment here is not going to be that easy, I don't think.
No.
Yeah.
Well, that's the trigger we've built into our forecast, right? So we have
exactly.
house price growth really, decelerating dramatically once interest rates start to rise even 25, 50 basis points. So.
Yeah. Good. And Cris, you brought up 17 trillion well, tell us what that was. Because you're right, it was 17 trillion.
17
What was
trillion
that?
is a household
Was that your
debt.
statistic, or do you have a different statistic? Or you?
I have a different one.
Okay, good. Yeah, let us know tell us about the 17 trillion.
Okay, the 17 trillion is household debt, total household debt as reported by the Federal Reserve earlier this week. So 11.3 trillion was mortgages. So that's still the dominant piece of it. It's rising, but it's not rising as quickly as assets overall. So my statistic
the assets
actually,
households own. Yeah.
yeah. So my statistic actually was 19.6%.
Oh,
Which-
is that the growth in net
is
worth or something?
Yeah, that is the growth in net worth. So it's related.
Ah.
But
And net worth is the value of what people own less what they owe. And you're
Correct.
saying that's their wealth. That, net
Yeah.
worth is wealth.
Yeah,
Assets
and
less liabilities, and that's growing by
nearly
almost
20%
20%.
a year, $23 trillion in just 1 year. That's incredible.
Let me ask you a question. Do you think they include crypto in there? Do you think they capture crypto in that? That's just data from the Federal Reserve, right? This is the financial accounts from the Federal Reserve that just came out, the Q2 2021 data. I bet they don't pick up the crypto. What do you think?
Well, supposedly, right? There's an other assets category in there. It should be in there.
We should look at that. Is that growing really fast?
I'll take a look.
Take a look. Yeah,
I usually ignore it, but
yeah,
you're right. It might be.
They might not be picking up, all that movement on the crypto side, because I think, wasn't the statistic there's $2 trillion in crypto outstanding now, something like that. So pretty amazing. Yeah.
There actually was another 17 in that report, which also stood out to me.
In the financial accounts from the Federal
in the
Reserve.
Financial accounts, which was really important, which was deposits. Household
I was going to say that, by the way.
Yeah.
I was going to say that.
I knew you would.
Bernard
that just
knows
blows my mind
that.
as well. $17 trillion in essentially cash sitting in people's bank accounts.
That goes to the excess saving because people have been sheltering in place and all the government support. What was it before the pandemic? Do you know?
Oh, I don't. I know over the last year it grew. Well, I guess this is before the pandemic. It grew by about $2 trillion. So.
$2 trillion. Well, that's pretty close to our estimate of excess saving. I think excess saving is the saving above which people would have done if there was no pandemic. And so we don't know what that exactly would have been, but that's our estimate. I think we are estimating 2.5 trillion in excess savings. So take 500 billion, invest in crypto and stock market and housing. That leaves you 2 trillion for your deposits. That all adds up.
It all works out. All right.
It all works out somehow. You see how we do that, listener? That's how economists make all the numbers work. Yeah. Okay. So we got to your statistic too then, Cris.
Yeah. We folded that in. So let's move on to Bernard, I think.
But can I ask on just to flesh that out, just a big picture-esque. So what is the big picture that you got from the financial accounts data? It's really the financial accounts from the Fed is the balance sheet of the economy. They look at the balance sheet. Everything else we tend to look at, income and everything else, profits, that's kind of the income statement for the economy. This is the balance sheet, assets and liabilities. So what was the big picture, takeaway from that?
Yeah, so households in aggregate are in great shape, right? Perhaps the greatest shape they've ever been in terms of asset growth over the last year. It's been tremendous, 23 trillion, and liabilities, although they've grown as well by about $1 trillion, right? It's still relatively small compared to that asset. So that makes me quite optimistic. And then those deposits, right? Those liquid deposits being at $17 trillion, that's a lot of powder that can come right back into the economy at some point, certainly provides some support to downside risk. What's missing from this report, though, is the distributional accounts. We'll get those in about 2 weeks. And I suspect what we'll see there is an awful lot of skewing still, right? The gains that we're talking about here in equities and house prices are really
distribution
accruing.
Accounts, meaning looking at assets and liabilities and net worth along the wealth distribution.
Correct.
Low wealth households versus high wealth households. Yeah. That's
right.
pretty cool data, actually. It's very cool data.
It's great
to look at.
And it's very timely as well. Usually when we've done those studies, we've had to look retrospectively.
Yeah. The financial accounts also provides a window into kind of the business's balance sheets, the corporate balance sheet. Did you happen to take a look at that as well? Any big picture takeaway from that?
I saw some, I didn't do a deep dive into that, but there was some growth in debts there as well, but not excessively so. It seemed as though the businesses are borrowing it. Yeah, they're not taking on a whole lot of new debt, which again gave me some encouragement about the future.
I don't take as much encouragement. What happened, I think, is if you go back into the teeth of the pandemic a little over a year ago, debt surged because corporations took down a lot of their credit lines because they were worried about liquidity, that they might run out of cash because of the pandemic. and now they're just letting those lines, get drawn down. But the level of debt, corporate debt, is still very, very high compared to pre-pandemic levels. So I'm not sure I'd take too much solace in it. Yeah.
At least it's not moving up.
At least it's not moving up. Yeah. Good point. Yeah, that's a great point. That's an excellent point. Okay. And Bernard, you're up. What's your statistic?
All right, so my statistic of the week is $2.9 trillion, and the hint I'll give is that this is policy related.
Oh, thank you for that, Bernard.
Yeah,
that was a big hint. Jeez. Yeah. Thank you so much. 2.9 trillion. And my guess is it's got to be federal government related. Kind of its fiscal situation, something related to the fiscal situation, right? No? Oh, okay. No. Okay.
Or not, yeah, right. Yeah.
Okay, it's not that. 2.9 trillion.
They're related to the debt ceiling?
No, nothing. It has nothing to do with the debt ceiling.
Fiscal.
Okay, well, the American Rescue Plan was 1.9 trillion. The reconciliation package they're debating in Congress is 3.5 trillion. That's not 2.9 trillion.
Well, I'll give you a further hint.
Okay.
The source is the Joint Committee on Taxation and the Ways and Means Committee.
Oh, so you're saying this is the tax revenue that they're going to raise to support the $3.5 trillion?
Exactly.
Oh, okay.
Exactly.
So explain the number for me. I spouted it out, but go ahead and explain the number.
So the number there, I guess you can decompose the number into two things. So about 2.2 trillion would be the tax increases that the House Ways and Means Committee, which are essentially the tax writers on the House side of Congress, that they're proposing. And then there's about $700 billion that would also be, the other part is the $700 billion that would come from prescription drug reform. So all told, you get about $2.9 trillion. And this is to, roughly to offset the roughly $3.5 trillion reconciliation package that's, it's now being debated. Right now, we've really only gotten sort of drafts of the legislation from the House, but we still have yet to really hear details from the Senate. And this is a bit tantalizing because it's really, at the end of the day, I think it's what the Senate wants is what the ultimate legislation is going to end up closer to. But already from what we've seen in the House Ways and Means Committee is that the tax increases that they're proposing are just not as far-reaching as the ones that Biden proposed. So a couple examples is they're only raising the.
Well, wait a second. Wait. So the $3.5 trillion package that's kind of being debated, that's about $1 trillion less than what Biden proposed, right?
Yeah,
he proposed
exactly.
$4.5 trillion. So they don't need to raise as much revenue to make it all work out. Okay,
exactly,
so now we're at 2.9 trillion. And of course, this is over 10 years, right? So
yes, over 10 years. Yeah.
So if you look out past the 10-year horizon, assuming they do everything they say they're going to do and future lawmakers stick to the script, they'll roughly pay for it, right?
Exactly. Yeah.
The 3.5 trillion will be roughly paid for by the tax increases.
But there's still some major wild cards because there are also Senate Democrats that don't like the prescription drug reform proposal. There's also we still don't have the SALT deduction, which is a very costly measure, and that is something that could be introduced towards the end in order to get the final bill.
Although we did hear yesterday from Speaker Pelosi and Senate Majority Leader Schumer that the Democrats have agreed, quote unquote, on a framework for tax increases that will pay for the 3.5 trillion. We just at this point we don't know what that is exactly, right?
Yeah, it was just a very wishy-washy statement. It seems like they're agreeing to.
Yeah. Right.
Yeah. So. Yeah. But still, there are a couple changes, I think a couple of distinct changes from what the Ways and Means is proposing as opposed to Biden. So, under Biden, he was proposing the top corporate tax rate to go all the way up to 28% from 21%. House Democrats instead are proposing it to raise it to 26.5. I'd say our baseline forecast is that even goes down to 25% to be in line with what Joe Manchin has proposing. So that's what's in our baseline forecast. Also, the top capital gains rate, Biden in his budget proposal called for raising it from 20% to 39.6%, whereas again Democrats are only looking for an increase to 25%. So it's much less than what the Biden administration was doing, was proposing. And also, Democrats are not going as far as Biden did in terms of, proposing greater tax compliance and even reforming, international tax rules.
Yeah, and I think at the end of the day, the 3.5 trillion is not going to stand either, right? I mean, when it gets
Nope.
Our assumption
Right.
is that gets whittled down to $2.5 trillion. And, next week when we discuss the October baseline forecast, we may even bring that down to 2 trillion.
Oh, see how he front runs us, guys? He's front running us, saying, look, I'm going to propose this. Get ready for it.
He's seeding the field here.
Yeah, so the Senate is got the reconciliation, and the House got a package of 3.5 trillion in tax credits and spending increases over a 10-year period. And just given the politics here, Joe Manchin, the Senate Democrat from West Virginia, who's very moderate, has said, I'm only willing to support a $1.5 trillion package. And right now we are assuming that these guys, everyone splits the difference and we land at 2.5 trillion. But you're saying, well, maybe that's even a little high given the politics here.
Yeah, that's the sentiment I'm feeling right now.
All right, fine. Let's let's have that discussion and debate. But 2.5 trillion, okay. Well, that's good. I've got a statistic. I got 3 statistics that all relate to each other, and I have to give you all 3 because it'd be too hard if I just gave you one. I know that sounds a little weird, doesn't it? These are all hints, by the way. All right, you ready? And this is a statistic that came out this week, and it's a monthly series, so it comes out every month. 0.9, 0.2, and 0.1. Any ideas what that is? 0.9, 0.2, and 0.1. You can ask me questions.
I know. I should know this.
That means you know it.
Yeah.
No, I'm thinking. Are you sure it came out this week?
I know I've done this before. I've kind of done a head fake, but no. This came out this week. Yeah, I think it came out towards the end of the week too. Yeah, recently. It's a statistic that people generally, it's an important one, but they don't, when I say statistic, a release, let's say, that comes out, people don't generally follow it that carefully, but I find it quite informative, and I'll explain why once you guys fail to figure it out.
Thanks for the confidence.
Yeah.
Is this the St. Louis Financial Stress Index? Or
No. 0.9, 0.2, 0.1. So it's 3 different statistics within this particular release. Okay. You tell me when you give. I'm trying to think if I can give you another hint. It goes to the business cycle.
I know. It's the conference
leading index. Yeah.
So what is it, Ryan?
Leading indicators. Conference board.
What's the leading indicator?
0.9.
0.9.
What's the 0.2? What's the 0.1? Oh, come on.
Hey, I'm getting one at a time.
This is like I'm spoon feeding you, man. All right. The coincident indicator and the lagging indicator, right? You got the leading indicator, the coincident indicator. This goes to where we are in the business cycle. And the leading indicator is a compilation of 10 different statistics that tend to lead contemporaneous economic activity. The coincident indicator is 4 indicators that are combined to reflect where the economy is currently, and the lagging indicator is what it sounds like. It's a set of indicators that are a bit lagging, which are also important because once they are definitively showing the economy moving in one direction or another, you're done. But I found it took some solace in it because it was a very strong increase, 0.9 in the leading indicator. That's a big increase in the month, and all but one of the 10 components actually rose. So that's an encouraging sign. And a coincident indicator I find useful too, and that includes personal income less transfer payments, jobs, industrial production, a measure of sales, of business sales, because that does a good job of pegging, where you are in the business cycle. And I use this as a way to assess whether the economy is in recession, in recovery, or in expansion mode. Expansion meaning that the level of the indicator is above its pre-recession level. And right now it's strongly indicating that the economy is in recovery, but has still a way to go to get back to pre-pandemic levels. So it's in recovery. It's not in expansion. And I really find the lagging indicators particularly useful because, again, it's proof positive of where you are in the business. If you've made a turning point in the business cycle, either down into recession or back up into recovery. So I do watch it pretty carefully. Very, very useful. Because Ryan's he's just struggling. Oh, that's not a good indicator.
No, it's a good one. I look at that one too.
You do look at it?
I don't look at the lagging indicator as closely as you do.
Yeah, I like that one. There's, what's in there is commercial industrial loans. Those are businesses, business loans that banks make, and I find that to be particularly useful. And inventories also, very, very useful indicator. Okay, before we move on to policy, I did want to call out some of the statistics that we've been watching on a regular basis. Two of them in particular. One is the 10-year Treasury yield. So that has been making a move again recently, Ryan, hasn't it?
Over the last two trading sessions, it's up 13, 14 basis points. So we're at 1.45% on the 10-year Treasury yield right now.
Yeah, pretty close.
So it's been quite the move over the last couple of days. And I think part of it, you've seen inflation expectations move higher, coinciding with the increase in oil prices. But it seems to be more of a delayed response to the Fed meeting on Wednesday, where they signaled.
Yeah, I don't get that explanation. Delayed response? I mean, like investors are sitting there drinking their coffee and like, I don't know what to do. Oh, let me make up my mind. Let's do it. Really? Is that what you think?
Remember, the trading session closes not that long after Powell gets done speaking. So
yeah,
it's possible. I mean, I have a hard time trying to explain what else would have driven a move.
What about the debt limit? What about the debt limit?
It's too early. Too soon.
Really? You think so?
And usually the debt ceiling goes the opposite way. It push long-term rates lower.
Hey, Bernard, what do you think? Do you think that the markets are starting to react to the debt limit yet, or the debt ceiling, or not yet? You think?
I have seen some, like if you look at 26-week Treasury bills that are maturing in late October, early November, you are starting to see a kink in the yield there, which is indicating that there's investors are trying to avoid some of those bills that are maturing around the potential drop dead date, where there could be a potential default scenario or delayed payment scenario. But it's nothing to the extent that we saw in 2013 or 2011.
Yes,
but again, the longer we get to to that date, the more we're going to see movement there.
Yeah, I guess it's hard to read too much in any 1-2 day movement of bond yields anyway. Right. There's so many technical factors going on that it's very difficult to discern. But the bottom was what, 1.15, 1.2? So we've moved off that. We're still well below the 1.75 that we were back in, I believe, March of this year, when we thought the economy was really rip-roaring. But now it's starting to move back up again. Okay. And Ryan, you think it's going to continue to move higher?
Through the rest of the year? No. I think it's going to head back down. I think the debt ceiling will take some steam out of the bond market.
You're saying just the opposite of what I'm saying.
Yeah, if you look at back like 2011, 2013, the initial thought was when you get close to the debt ceiling, interest rates are going to rise.
Yeah.
But it's the opposite. The bond market starts pricing in the apocalypse, and rates actually go lower.
Wait. You, I think, did a study back on the 2013 debt limit, and rates rose. You said 6 to 10 basis points. Bernard, he doesn't even remember his own study.
No, I remember that. But
I thought it was actually a damn good study.
Yeah, it was looking at the cost to the taxpayer of the debt ceiling fight. And I think we used short-term rates as well. I think it was all in. But I can go back and look. But
yeah, take a look. Yeah.
If I had to bet, 10 years coming back down over the next few months.
Okay, so you're saying, there's two countervailing forces here. One will lead to higher rates, and that is, I'm nervous that I'm not going to get paid on time. I'm Mr. Bond Investor. Therefore, I'm going to start selling, or I'm going to stop buying as much. Yields rise. And the other countervailing force is the one you're describing. Well, the debt limit is bad for the economy. It's going to take steam out of the economy, makes it less likely the Fed's going to raise interest rates, takes the knots potentially out of inflation expectations because of the weaker growth, and that lowers your yields. And you're saying if you had to take one side of that or the other, that it's the lower yields that's going to prevail here. The worries about growth.
Yeah. I think we'll get back some of these gains in the 10-year over the next few weeks, and then towards the end of the year, we'll see rates rise as the Fed actually begins to taper their $120 billion in asset purchases.
Interesting. Right.
It's going to be a little bit of a roller coaster ride. It all depends on what happens with Washington. I mean, if they botch and we have a government shutdown or a nasty debt ceiling fight, they're not going to taper.
Sure.
Yeah, so that's interesting. So you're saying if we actually have a nasty debt ceiling battle and we come up we head towards the drop dead date, which we'll come back to when we get to this as a big topic, the Fed's going to delay when it starts its tapering, and that will be a reason for lower yields. Yields will go down.
Correct.
Interesting. Okay.
And this isn't the beginning of a taper tantrum. Like, this is very orderly. This isn't 2013 all over again.
Right.
It was communicated well.
Mm-hmm.
Yeah. What were you going to say, Cris?
I said it was communicated well.
Yeah.
Powell was very clear.
Yeah, we'll come back to that. Okay. Interesting. I don't know. That makes me even more nervous because policymakers see interest rates go down. They go, "What are you economists talking about?" And raises the odds they actually do breach the debt limit default. Interesting. Okay, the other statistic we've been following that I want to call out is unemployment insurance claims. Cris, that's been your statistic. It actually moved back up in a pretty definitive way last week, right?
Yeah, 351,000 last week, up from 335,000. So, wrong direction. And then if you look at some of the state level detail, California and Virginia had some of the largest gains. And so that suggests at least that COVID, the Delta variant, may be playing a role here in terms of deterioration in the economy, people having to apply for insurance due to that weakness.
What about Ida? We had this hurricane blow through during this period, scrambled things. Do you think that played a role at all? Could you see it? I don't know, Ryan, you look at this really carefully. Did you see it, Ida, in there at all?
2 weeks ago. So we went from claims that were like 308,000 up to 330, somewhere around there. That was Ida. Because you look at Louisiana, you saw a big increase in unemployment insurance benefits there. This past week that Cris referenced, when we went up to 351, Louisiana actually saw a decline in unemployment insurance benefits. It's California, it's Virginia. There was no Hurricane Ida effect. Okay.
So should we be at all nervous about what's going on with UI claims? It's kind of 350 is a high. Our kind of breaky, our benchmark for really good is at least 250, right? We debated it, but say 250. Yeah. So we're 100K above what we consider great or good, and it's moving up a little bit. Or is it just the data?
A little bit of a noise. If you look at the 4-week moving average, it's flat. So it's I would say it's in the yellow zone. It's caution, but assuming COVID, some of the more recent trends continue, we get some improvement there. We should see some pickup in employment, and that should temper things down or tap things down.
Why last week's number was important is it includes the September payroll reference period. And if you look at claims between August and September payroll periods, it's flattish, like Cris described. So it would, at face value, suggest that we're not going to get a big bounce back in job growth in September.
Yeah, I was going to say that. So what do you think? Are we, like in August, we got a gain of 250K, I believe, in the payroll. I mean, in the month before we got $1 million. The month before that we got close to $1 million. So August was really disappointing. So what do you, are we lining up for 250K or maybe
it's
not?
Hard to say. I'm still digging into it because we have the Hurricane Ida effect. So it's going to take me a little bit longer to pinpoint that number.
Yeah. Okay. All right. Hey, Cris, I wanted to ask you one other thing. I believe the state level employment data came out for the month of August, and we've been scouring that data to get a sense of whether the supplemental unemployment insurance program has distorted, decisions by workers to go back to work. There's been a lot of debate about that. The July data showed that there was no difference in employment growth in states that held on to the supplemental UI to the end. It ended in early September, compared to those states that ended the supplemental UI early, leading to the conclusion, or at least the tentative conclusion, that the supplemental unemployment insurance had no meaningful effect on the job market, that it wasn't constraining job creation. Did you look at the August data by chance?
Yeah, I did. And
You did,
our
okay.
colleague Adam Kamens also had a really nice write-up on the Economic View on this topic, so if you want more details. But the August data also refutes the notion that extended UI benefits were holding back this surge of employment. We just didn't see that. So if you look at employment from May to August across the different states, you actually see that employment growth was weaker in those states that that ended the extended benefits early, right? So again, refuting this theory that if we cut the benefits, then folks will rush back in the labor market. And actually, the bottom 10 performance, 8 of the worst performance in terms of employment growth were those states that that had terminated the unemployment insurance benefits early. So
is that right? Oh, geez.
Yeah, so it's
just the opposite.
there are some other factors. I won't say it's definitive.
Yeah, sure.
Right? You have to control for a lot of things, but at least on the surface, I don't see any evidence to suggest the opposite. All right, it seems like a policy mistake was made here to cut those benefits early.
Okay. Anything else to add on that, Ryan? That point, that question?
No, I agree with Cris that we've rank ordered why people are not re-entering the labor force, and that was at the bottom of the barrel. I think number one is childcare issues, and then right behind it is concerns about COVID. But what is interesting, if you look at some of the summaries of corporate earning calls, they are blaming UI benefits.
Are they?
Oh, really?
It's like this disconnect between the data and what you hear.
The anecdotes.
Yep.
Yeah. I go with the data.
I
Of
agree.
course, I say that with some trepidation because it could be revised, I guess, right?
Yeah,
So
Yeah.
we'll see. Hey, before we move on to policy, monetary, fiscal policy, one last topic I wanted to ask about is what's going on in China, the Evergrande kerfuffle. This is the big real estate company, Chinese real estate company that I guess is defaulted now, right? They missed a debt payment, I believe. They're in a grace period when they can kind of make it up, but it doesn't look like they're going to. Seemed to be creating some consternation in markets. The stock market was down a few days, ostensibly because of that. Who knows, but ostensibly. Any points you want to make about that? Any insight with regard to Evergrande? Do you think? Let me ask it this way: do you think there's any connection between what Evergrande, what's going on in China, and what it means for the U.S. or the rest of the global economy? Anything at all? I mean, were stock investors right to be worried about this? Cris, do you have any views on that?
I think it's part of that broader narrative in terms of concerns about the opacity of data in China overall, right? And so this is a manifestation of some of those concerns that, there's more below the surface than what we're seeing. So I think that is certainly continuing to drive investors away or think twice about investments in China.
And there was a clear market reaction, but the good news is the high yield corporate bond spread, it didn't blow out. It didn't increase substantially. It did widen, but overall it seems like the corporate bond market took the Evergrande issue in stride, the U.S. corporate bond market.
Yeah, I find it hard to connect the dots, certainly directly connect the dots between Evergrande and the obvious broader stress in related to the high leverage in China and the U.S. economy, or even the global economy. I assume there's indirect effects if Evergrande suggests that the Chinese economy is going to grow more slowly because it has to adapt and adjust to kind of righting the wrongs it's been engaged in with regard to over borrowing. But those are more indirect. I don't see them as a direct effect. You would agree? Anyone
I agree.
disagree with that?
Unless
Okay.
it really causes a sustained response in U.S. financial markets.
But why? Why would it?
I'm saying I don't think it would, but that's the only dot that I can connect.
But there's no that Evergrande has the reports are $300 billion in liabilities, debt, and it doesn't appear that the U.S. or other developed world financial institutions have any real exposure to that. That's almost entirely domestic.
Correct.
So the other thing I'd say is I can't imagine Chinese authorities allowing it to get to a place where it's going to do any real damage to the Chinese economy. I mean, they have bailed out other companies. So if it looked like this is going to be a systemic problem, meaning the default on that debt takes out Chinese banking institutions and other financial institutions, and this becomes kind of a self-reinforcing, mess like our own financial crisis a decade ago, Chinese authorities would step in right away. I would think. I can't imagine they wouldn't. So hard to see the fallout here. But anyway, okay. All right. Let's turn to policy. Let's begin with monetary policy. And the Fed met this week and, kind of advanced the ball on their thinking around QE and their forecasts around future rate increases. Ryan, you follow the Fed closely. You want to fill us in on what they said and what your interpretation is of what they have in mind here going forward?
Yeah, of course. So the all eyes were on any indication that the Fed was going to announce any tapering plans. They didn't, but they took the long anticipated first step in their advance notice that tapering is coming, and that was included in the statement. And it seems like they're going to start tapering either in November or December, depending on what happens in financial market conditions, what happens out of DC. But it seems like we're headed for an 8-month tapering process. So roughly 15 billion reduction per month in their asset purchases. The other notable thing in the FOMC's meeting was they released their updated summary of economic projections. This includes their projections for GDP, unemployment, inflation, and the so-called dot plot, which shows participants' expected path of the Fed funds rate, and they're divided. So 9 participants expect the first rate hike in 2022, and 9 expect it in 2023.
Yeah, and the Fed funds rate's the rate they control. So you're saying
Correct.
I guess 18 members on the Federal Open Market Committee, FOMC, that's the policymaking committee of the Federal Reserve, said that they think the first rate increase will occur in 2022, and 9 said first rate increase in 2023. So it's kind of
Correct.
evenly split. And our forecast is still for what, January of 2023?
Correct. And that's
January.
where I think the Powells, the Branyards, the Claritas, the ones that really matter on the FOMC, I think that's where they are right now.
So those dots are not all equal.
They're not.
One dot is not as heavily weighted as another dot.
It's every summary of economic projections, I kind of put names on dots. So
When your wife asks you what you do for a living, you say, I look at dots and I decide,
Exactly.
which dot is Jay Powell and which dot is
Brainerd,
and Kaplan and so forth and so on. That's what you do for a living.
Oh, yeah. That's what I do.
And people pay you for that.
Well, you asked me what's going to happen to interest rates, and you got to know whose dots who.
Bernard, can you imagine that's what someone does for a living? Can you imagine that?
Kind of looks like my first grader's artwork.
Pretty funny, actually. Yeah. So on QE, quantitative easing, that's bond buying. They've been buying 120 billion in Treasury securities and mortgage-backed securities a month since early on in the pandemic, and they're now signaling that they're going to start so-called tapering, which means reduce the amount of bonds they are buying. And right now, you think they are that process of reducing the bond buying will be when? Is it December of this year? December of 2021?
I think it's November. They want to wrap this up by mid next year. And if you listen to Powell's press conference, and yes, of course, I listened to Powell's press conference and put names on dots. He kind of had like a wink moment where he was like, he was reading between the lines. It seems like he wants to go in November, barring any issues on the debt ceiling and at least a decent September employment report.
Yeah, I suspect though, who knows, but I suspect that the September job number is going to be on the soft side too. Going back to the UI claims and given other evidence that Delta has done some real damage here to the economy. And also this brinkmanship over government shutdown and debt ceiling. That's going to be pretty messy, I think. Don't you think? So don't you think the odds are pretty high here? If I were them, why wouldn't you wait a month just to make sure we're on the other side of the debt limit and the government shutdown and we're on the other side of the delta? Why not? Why wouldn't you do that?
Well, I think that's why we keep our forecast. I mean, as of today, I think it's
okay.
possible.
So our forecast is still December of 2021.
I would not change it. Yep.
You would not change it. Okay.
I think they want to go in November, but in reality, given all the headwinds over the next few weeks, it's going to be December.
Right. Okay. Anything in the statement, in the forecast that they put out in Powell's press conference afterward that surprised you, or you just said, "Oh, that's interesting. I didn't know that," or that's an interesting way of looking at it. Anything that stood out?
Jumped out. I mean, I think they are still buying into the transitory argument. They revised higher their forecast for
transitory argument, like nobody knows what the heck
temporary.
you're talking about.
All right.
Temporary what?
I'm getting there.
Okay, sorry. Go ahead. I get impatient. Bernard knows.
Did you have your Wawa coffee yet today?
The problem is I had too much Wawa.
Oh, there you go. So inflation has accelerated noticeably this year, and it's transitory factors, so temporary factors are behind the increase. And as those fade, so the reopening of the economy, the supply chain issues that's driving used car, new car prices higher, once we're on the other side of that, inflation is going to moderate. It's going to slow down. And the Fed boosted their inflation forecast for this year, just reflecting new data that came in. And they really didn't adjust their forecast for inflation over the next few years, which has it coming back down towards their 2% target. So they're not wavering yet on the transitory inflation view.
Hey, I got a good question. One more question on monetary policy, and we'll get to fiscal policy. How would you define transitory? What is transitory exactly? When does it become non-transitory or persistent?
That's a great question. I get that one a lot from clients. So I think
I've got an answer, by the way.
Yeah, I want to compare mine to yours, to Chris's.
Yeah, go ahead.
I say 9 to 12 months.
Oh, you actually have a time. There's a time dimension, 9 to 12 months.
Oh, where are you approaching this? You're talking about the rate of inflation?
Okay, I'll let you know in just a second. I want to hear what Bernard and if Bernard or Cris have a different definition of transitory.
I was thinking 12 months, so still.
12. Well, so what does that mean? So you mean
less than 12 months
from now, inflation has to be back to target, or
no, it's got to be moderating.
Moderating, yeah.
Definite in your forecast is for it to get back to target.
Yes,
correct.
Yeah.
Okay, that's my definition. That
okay.
Inflation expectations are, stable, firm. People believe still that inflation is going to come is going to come back into the Fed's target. And the other is, it's a kind of a more fundamental definition. The other is labor costs. That, if labor costs, meaning wage growth less the growth in productivity, or unit labor costs, to use a technical description of labor costs, that's stable. That it's not accelerating in a definitive way. So if those two conditions are holding, then this is transitory. It's going to fade away. Inflation is going to come back to it. It may be 6 months, and maybe 9 months, and maybe 12 months. It could be 24 months, but I still view it as transitory. It's not persistent. It's not going to be a persistent, elevated level of inflation. So, because I don't, I'm not sure if it's 9 or 12 or 18. So what do you think of that way of
I'm surprised by that. You don't put
really?
a time. I thought you would have a time dimension on transitory. Because I got you pinned as an inflation hawk.
I am an inflation hawk.
So if you were on the Fed, I know exactly what dot you would be.
Really? Well, so would I be into 2022 or 23?
Yes, 2022.
Yeah, I'd be in 22. I would be in 22. You're right about that. Yeah. But I'd be a flexible hawk, I think. I mean, the facts,
you'd be like
man.
a realistic, realistic
facts,
hawk.
man. Yeah. Okay. All right. Well, let's. Anything else on monetary policy? Anything else? No. Okay.
I mean, if you want to go international, the Bank of England meeting was pretty interesting.
Oh, why?
They really boosted their inflation forecast. And unlike the Fed, they're getting nervous about inflation. So a rate hike this year is on the table for the Bank of England. And they're also doing something different than the Fed, where they will start raising interest rates before they start reducing their monthly asset purchases. So we kind of have
hawks.
Yeah, exactly.
So what's the deal there?
I don't know. Kind of reminds me of what the ECB did back in, was it 2013, when they saw the first whiff of inflation and they started raising interest rates, and then we know what happened after that.
Yeah, that's crazy, huh? All right, that's good to know. All right, fiscal policy. So, Bernard, how scared should we be here? Right? I mean, we've got the government is going to shut down on October 1, the start of the new fiscal year for the federal government, if there's not a piece of legislation that provides funding, at least for some period of time. And by our calculation, I should say your calculation, by October 20th, the Treasury will run out of cash to pay everyone on time. Someone's not going to get paid. And actually, I was looking at data you put together. On October 20th, there's a big payment to Social Security recipients. I believe a $20 billion payment on that day. And they might not get paid.
It's October 15th. You get some interest payments. The child tax credits go out.
I'm telling you, it's on October 15th, there's a big payment, and then they have a cash surplus on the 17th and 18th. You're talking to a guy who just looked at this data.
Yeah.
Yeah. You're telling me I'm wrong? Is that what you're saying, Bernard?
I in mid-October, it's really the 15th that I see like the biggest, pressure point for cash reserves at the Treasury.
Oh, you think drop dead date is the 15th?
No. So I'm just saying what really leads up to that October 20th drop dead date is that, on the 15th you get a lot of payments, and that just really whittles the borrowing capacity under the debt limit to just dangerously low levels, and then we finally hit the X date on the 20th.
Yeah, X date. Everyone's calling it the X date. Okay, so all right. Bottom line. How nervous should we be here? What's going to happen?
So I'm not nervous at all about a government shutdown. I'm a bit more worried about the debt limit. So with the government shutdown, the House recently passed legislation that would fund the government past October 1st through early December, and then they paired that with a debt limit suspension. So suspending the debt limit through December 2022. So that passed in the House with, I think it was it was a party line vote. I don't think you had any Republicans support that. And now it's going to the Senate, where Republicans have vowed to block it. And I think the
block
the
it means filibuster it.
Filibuster it, or filibuster it. And I don't. I think that what Democrats were trying to do what they're trying to do is to get Republicans on record that they're willing to risk a shutdown just because they don't want to raise the debt limit. And they're also trying to dare them to block a package that would also provide hurricane assistance for Ida, which affected red states like Louisiana. And then there's also some popular provisions that would provide assistance to Afghani refugees. But I still don't think I don't think Republicans are going to cave. I think they're going to block it. They're going to follow through with
block it means I want to make absolutely clear they're going to filibuster this.
Exactly. They're going to filibuster this. And then at that point, Democrats, they're going to really have no other choice but to, redo that bill, just make it a clean continuing resolution that just extends the, funding for the government through early December, provides hurricane assistance, assistance to Afghani refugees and so on and so forth, but without any debt limit suspension. And they should be able to do it in time. If not, at the very worst,
in the next few days.
Yeah,
in the next few days.
Yeah, next week. Yeah, the next week.
Next week they got to do that. Okay, so this is all going to play out. What you just described, this scenario is going to play out next week, and by
next week,
by I don't know when October 1 is. I guess it's the following Monday.
It's a Friday, I think.
It's on the next Friday. Okay,
so that's where
right.
we could potentially have a shutdown, a 1-day shutdown. So, on
Yeah,
Friday
right.
you get a shutdown, and then on Monday over the weekend,
Reopens.
they get together and, they pass this continuing resolution, and everyone's back to work in the federal government on Monday. So, if we were to get in 2018, we did have I think it was like a 1 or 2 day shutdown. And, it's the economic effects of that is almost, it's so on the
Yeah,
margins.
it's not a deal.
It's not going to
Yeah.
show up. You really
Yeah.
need to have 2 to 4 weeks of a shutdown for that to really show up. And even there, that's not that's not
Well,
going
I
to be the
think
gauge.
in 2013, and this is work we did back in 2013. 2013 was the last time we shut the government down, I think, for 16 days. No,
No,
wait.
in
No, we lost
2018,
2019, but that was
2018.
also,
So yeah,
2019.
and that was the record long shutdown. Yeah, that was the longest shutdown we ever
Yeah,
had.
I'm sorry. Yeah,
Um,
that's also when we had the last real debate over the debt limit was 2013, and we combined with
Correct.
yeah.
Yeah, so it was government shutdown, similar kind of environment as we have today. Where
I'd actually say the closest environment to the one we're today is 2017, because we also had, on various aspects. So you had a shutdown risk, also a debt limit risk. Then you had had Hurricane Harvey, Irma, Maria, and that there was a lot of pressure to provide aid there. And then also at that same time, just like now, Republicans were considering reconciliation to pass the Tax Cuts and Jobs Act. So it was.
But just to go back to the question about the economic impact of government shutdown, we didn't do a study on the 2017 or 19 shutdowns, but on the 2013, when the government was shut down 16 days, we found that it shaved almost a half a point off of that growth in the fourth quarter of 2013. So, it was meaningful. It's small in the grand scheme of things, certainly in the current context, but not inconsequential.
Yeah.
Yeah. Okay. So the debt
I think
limit.
our rule of thumb is.
Oh, go ahead. Yeah. What is
our rule of thumb is 0.1% off GDP per week of a government shutdown.
Oh, that's a pretty good one. Yeah, it's a pretty good one.
So it's kind of easier to think about it on a week-to-week basis. How much is it? Per
It's
GDP?
a good rule of thumb. Yeah. Okay, so the debt limit will not be part of the so-called continuing resolution. That's the short-term funding bill. You think they get that through? Republicans don't want to shut the government down. That isn't great politics. And of course, there's money in there particularly because there's money in there for Ida hurricane victims. So you're saying the debt limit increase will be then folded into the reconciliation package. That's the $3.5 trillion package that's before Congress.
Exactly. And this is where, this is something that, you and I dug into over the past couple of weeks, because the media really hasn't been talking about, all the procedural hurdles it would be to do this through reconciliation. It's really not as easy as I think people think. So, to start the reconciliation process, which is, passing spending tax legislation with only a simple majority and with a filibuster-proof, a simple majority in the Senate, you first have to pass an annual budget resolution, which essentially sets the priorities for fiscal policy over the next several years. And you can only pass one budget resolution per fiscal year. So they've already passed in August, they already passed the budget resolution for fiscal 2022. They can't do another one. So they have to amend this current budget resolution and include instructions to raise the debt limit by a certain amount. So, and this is where, it starts, and this is where the Senate parliamentarian who interprets the rules of the Senate starts to come in play. So, if the parliamentarian says, okay, Democrats, you can make that revision, I'd say Democrats would be able to pass a reconciliation bill that addresses the debt limit, I'd say in 1 or 2 weeks. But this still assumes Republicans don't obstruct the process, by denying them a quorum in the Senate Budget Committee or offering unlimited amendments that really gum up the works. But even in this case, I don't think Republicans would be obstructive. While Republicans don't want to help Democrats raise the debt limit, they're not going to prevent them from doing so, because as I said, they want Democrats to 100% own this debt limit increase so they can attack them in next year's midterms for being fiscally irresponsible. But then there's this other scenario that I had never thought.
Before you go on, the one nuance here is that in this reconciliation package, it's very unlikely they could actually suspend the debt limit like they have been doing for a decade. They're going to have to increase the debt limit, and it's going to be a big increase, right? It's
Yes,
going to be,
yes, yeah, yeah.
and if they have to, and that complicates the politics of this even more, right? Because, getting 50 Democratic senators to agree, even without this debt limit increase, is, we're watching it. It's not easy, right? Because you got folks, progressive Democrats, you've got moderate Democrats. Finding the middle ground is, as you can imagine, a process. And then you throw into the whole mix this, you got to raise the debt limit, increase it, which is politically not a great thing.
Yeah.
It complicates it even more. So that does raise the degree of difficulty. This is like a gymnast, on the parallel bars, and this is a high level. The degree of difficulty was already, I don't know what the numbers are, but let's say a 9.5, and now it's like a 9.9 kind of degree. Did I get that right? You get my drift, right?
Do we have a Simone Biles senator out there?
And if they get the twisties, we're doomed, right? Right, we're doomed. So do I have that right? Did I get that right?
You got that right. Okay. Because I mean, if they have, so if you suspend the debt limit, you kind of wash your hands and walk away, and you don't really know. No one can tell how long, how much the debt is going to increase over that suspension period. But if you say we're going to increase it by a dollar amount, let's say by $1 trillion, that's where next year Republicans can come at Democrats and say, hey, they increased the debt by $1 trillion, and again, it's a good soundbite that really hurts Democrats, even though, as we all know, raising the debt limit doesn't approve new spending. It only allows the Treasury to pay for bills that have already been approved by Congress. Yeah. So it's but again, that's too much for a soundbite on the political trail. So
okay,
so that's where it's
So you're saying I'm not worried, because I do think this is the way it's going to play out. It's going to feel uncomfortable, come down to the 9th hour. What do they say? The 10th hour? The
11th hour. Yeah.
11th hour. I knew there was a number. 11th hour. And they're going to figure this all out, and life goes on. Okay. Is there any downside to this? I mean, does this have any longer term implications? If that's the scenario, the most likely scenario, does that have any fallout?
Yeah, so it basically means that from now on, whenever a party is fully in control of the White House and Congress, and there's a debt limit standoff, it means that the party in the minority is going to say, I don't want to help you. I don't want to help the majority out. You guys do it on your own. We're not going to be part of this. And so in that sense, going forward, debt limit episodes are going to there's not going to be any really any bipartisan will to help each other. And also, it could also, this scenario could also turn a darker turn. So let's say the parliamentarian who I just mentioned, let's say they say, you can't actually revise the budget. And there's the parliamentarian has given some guidance that suggests that she may even actually rule against this. You could have a case where the vice president, who is the presiding officer in the Senate, actually overrules the parliamentarian, and this would also be just a very rare occasion, something that we haven't seen in decades. So that would also sort of set a bad precedent that I don't think Democrats would want to.
Yeah. So what you're saying, just to reiterate, is okay, even if you get this, what you consider to be a reasonably graceful scenario, there's fallout, because going forward, the precedent has been set that the party in power is going to have to do this on their own. Yeah. Which means it's going to be, the degree of difficulty going forward is now perpetually higher.
Exactly.
That means more uncertainty, and that may mean, by definition, economic implications, higher interest rates. All that stuff. Yeah. Very unfortunate. Okay. And we did consider the kind of the darker alternative, one variation of a darker alternative scenario where they don't agree they can't figure it out for whatever reason. They can't raise the debt limit in time, and they do default, and this drags on through, basically through Thanksgiving. That's a pretty dark scenario, right?
Exactly.
Hard to imagine.
Yeah. So if we are right, and October 20th is the drop dead date at which the Treasury can no longer meet all of its obligations on time and in full, Because we run annual deficits, that means that, on a day-to-day basis, the Treasury is going to have to cut its spending in order to match incoming revenues. And over this period, over let's say from October 20th through the end of November, revenues, the Treasury we're estimating that the Treasury should receive enough revenues to pay for about 60% of the bills that are going to need to be paid. But that's still a 40% decline in spending, and based on the math that we did, that would equate to more than $200 billion in unpaid bills over this period of time, which if you annualize it, that comes to about, a whopping 10% of GDP. And this is where you get into all sorts of prioritization scenarios. There's just, which are really, impracticable or even illegal. I mean, I think, it'd be easy for them to prioritize interest and and debt payments, just because all that's managed through a different computer system known as Fedwire. But everything else is very highly computerized, and it would be just technologically very difficult to say, okay, we're not going to be paying Social Security beneficiaries this day, but we'll pay veterans benefits, and just sorting through the millions of payments that go on each month is just impossible. So
so the point is that going down the dark path is so dark, there's no chance they're going to go down it. That's what we're saying. They're just not going to do it. Hey, have you heard about this $1 trillion platinum coin? Have you been following this?
I've been hearing that, but what I've heard is that's impractical.
Well, what is it? Explain what it is, and then tell me why you think it's a harebrained idea. I'm guessing you think it's a harebrained idea.
So I think it's as calling for the Treasury to mint a $1 trillion platinum coin, which they would then use to
deposit at the Fed.
Fed, and then use that as as cash to get
pay
through
their bills.
That's
and apparently the way the law is written, it actually says the Treasury can mint a platinum coin of any denomination. I mean, it's actually there. It's actually there. But you don't. So let's say they can do that. Let's say they practically legally can do that, which I guess is going to still be a question. Someone, I suppose, will challenge it. But although I don't know who has the standing to challenge it, I'm not sure. But let's just say that it was challenged. But regardless, why wouldn't that work? Or don't tell me you think it is going to work.
It's going to work.
I think again it's just another precedent that they don't want to establish. It's just very.
It's not going to work, guys. It's not going to work. I'll tell you why it's not going to work. Because a global investor is going to see that and they say, "Are you guys out of your mind? That's not sustainable."
But it's exactly what we need to get rid of this crazy debt ceiling discussion every few years, right?
We should just eliminate the debt ceiling. I think that's the
we should eliminate the debt ceiling. For that. Yeah, no, I think global investors look at that and they throw up all over it. They'll say that's even worse because you guys are going to turn yourself into a pretzel to do that. That's not going. And so it's not going to work. And at the same time, you destroy our system of government, right? Because at that point, president is complete. Can you imagine? President Trump, I guess, could have issued a platinum coin to fund the building of the wall, right? Is that what we're saying?
Yeah.
Right, Cris, you're the defender of this policy.
Yeah.
That makes sense to anyone that the president can completely unfettered here, could do whatever he wants. So that completely.
Are you arguing?
Apart the system of government.
Are you defending the debt ceiling? Do you think
this is ceiling. I said get rid of the debt ceiling, but I'm not saying
this is a mechanism to spur that change, right?
Oh, are you kidding me? This is going to do that. It won't spur that. It'll just create even more acid politics. I mean, it'll send us way off the rails. Well, this is. But I've seen, I think Krugman endorsed it. I believe Paul Krugman, the New York Times columnist, Nobel laureate in economics. Yeah. So it's gained some traction, I guess. And it's got Cris over here as a convert. Ryan, do you have a view on this platinum coin? I think we lost Ryan. Did we lose him? Yeah, he's frozen.
I've got an improvement on it though.
Oh, well, okay. What is it?
$2 trillion.
We should issue crypto.
2 coins.
2 coins. Okay. Yeah, I like that idea. That's a great idea. In the conclusion, we wrote a paper on this, going through the dark side scenario, and it's as I mentioned earlier, it's on Economic View, and I just wanted to ask about the way I wrote the conclusion. What you think? I thought it was very eloquent. My own personal view. I don't know what you think.
Yeah, about how this is, the full faith and credit, and defending that is, really.
Well, I brought up Alexander
Hamilton. Yeah.
Hamilton paid off the Revolutionary War bonds, 100 cents on the dollar. Since that day, he established the credit of the United States. If you invest in the debt of the United States of America, it is money good. You're going to get your principal interest on time. Exactly. That has led to very low interest rates, lowest in the world. It's established the U.S. dollar as the reserve currency, and the benefits of this are incalculable. And we are going to give this up, all of this up for what exactly? Because of a debt limit that never worked in the first place. I mean, it's just mind-boggling.
I do want to make a point. So when the debt limit was originally conceived, I think it was around World War I, it actually was a good idea, and it was an improvement upon the prior situation that gave more flexibility to the Treasury to manage the nation's debt. And that's because prior to World War I, Congress had to approve each, the dollar amount of every debt issuance, and as well as the purpose that issuance would serve. So that was just a very, cumbersome process. So around World War II, they said, okay, we're just going to put an aggregate limit. And it's up to the Treasury to issue the debt that it wants for the purpose that it wants, and then every now and then we'll when the debt limit needs to be raised, we'll come back and and address it there, and I think until the 90s, this never really was much of a contentious issue, but it was really, I think, with when you had former President Bill Clinton going head to head with Newt Gingrich, who at the time was trying to push through his contract with America, which were spending cuts and tax cuts. That's where it started to become weaponized or being used as a political football. These debt limit standoffs.
Hey, I got one proposal for you though. How about if we, and then we'll call it a podcast. How about if we, it's a law was changed, no debt limit, at least as currently designed, structured, but with each spending or tax bill where the CBO, the Congressional Budget Office, the folks that do the forecast here on the budget, determine that there's going to be a deficit as a result of the spending or tax bill. At that point in time, with that legislation, Congress and the president have to agree to raise the debt limit sufficient to pay for what they just voted for. That to me seems reasonable.
That's the best proposal I've seen. Yeah, because the whole idea is that by the time.
Oh, I thought that was my proposal. What the heck? You seen that proposal?
Yeah, I've seen it. Yeah, Committee for Responsible Federal Budget, they've put out.
No. There's really, it was theirs. That was their idea.
I think it's a proposal that's been out there a long, been around. Okay. So, and I think again in a alternative universe where there's constructive debate over budgets and fiscal policy, I think that would be fine, because it would as soon as people are making changes to taxes and spending that are going to affect the long-term debt trajectory, they're going to have to they're going to see the implications right away on the debt limit. Whereas now it's so after the fact, by the time we're dealing with the debt limit, all these decisions have already been made years or months ago.
Well, so bottom line, we're saying we're going to get a funding bill to keep the government open, maybe it's closed for a day or so, that we are going to get a debt limit increase, and that'll be part of the reconciliation package that the Democrats get through ultimately through Congress and signed by the president. And then we'll get the reconciliation bill. It won't be 3.5 trillion, but it'll be something still a matter of, debate, but say about 2.5 trillion. So at the end of the day, this is not pretty to watch, but it's not going to be it's not going to change our forecast in any way. That's our forecast. That's where we land. Okay. All right. Very good. Well, the United States of America, I if you're a Game of Thrones fan, and I guess I was until the last episode, but I view the United States of America as the Lannisters. We pay our debts, and to even contemplate not paying our debts is just plain dumb, because it's going to cost us as taxpayers and, American households, just the economics of it, it's going to cost us a lot. And it, not for a little bit of time, for generations, right? Because it took us generations to build up our credit and get us to a place where everyone trusts us. By the way, the only beneficiary of this, in my mind, is Cris. You know why? Crypto. His crypto is going to be worth more God. Because this debases the value. It goes right to what the crypto guys say about fiat currency, about, look, these guys are going to screw it up because they can, and they will ultimately screw it up. And that's why you need crypto, because people aren't involved. They're not going to be able to mess with it. So on the day, if we ever defaulted on our debt, that's the day crypto goes to, what is it now? $40,000, it'll go to $80,000 or something like that. Maybe that's the reason to invest. I'm not sure. Yeah, this is
Janet Yellen will save the day.
Yeah, Janet
Don't
Yellen
worry.
will save the day. Okay, all right, guys. I promise this wasn't going to be the marathon that the last one was. We have been chatting for a bit though. So, any last words? Anything anybody wants to say? That offer does not extend to Bernard. He is not permitted to answer that question, because then he'll start speaking in Arabic or some other 10 languages he knows. Anything, Ryan?
I think we're good.
We're good. Chris,
Until
you
next
good?
week.
Yeah, all
Good.
set.
Good to have you back, Chris. I missed you.
Thanks. Same
You're
here.
back with your howdy doody shirts. We needed the little howdy doody shirt there. I'm telling you, right? Look at
Howdy
we're all
doody.
in
How is this a howdy doody shirt?
button down collars and blue, and anyway, I'm only joking.
I missed the teasing. So.
All right, listener. I hope you enjoyed the podcast. Give us ideas. Go to economy.com. Go to economy.com. Click on the Inside Economics button and vote. Hey, I just had a debate on ESG investing. The proposition was ESG investing will undermine the American economy. I did not support that proposition. I was against that proposition. How about that for a topic? That's kind of cool, huh? Should we have that
Great
as a topic? All right, listener,
Who's
if you think
taking the
that's a
other
good
side?
topic, let me know.
Right.
That'd be good to debate that one. Anyway, all right, take care now. Until next week.